Welcome to Talk Tickers. We're your shortcut for understanding today's critical earnings calls. And today, we're digging into Moody's Corporation. Their first quarter 2025 results just dropped.
Yeah, and it looks like a pretty strong start to the year for them.
We'll break down the key financials, the strategic updates, and, what it all might mean.
Absolutely. This quarter, Moody's seemed to be firing on all cylinders. They hit record first quarter revenue.
Record revenue, okay.
And profitability saw a nice jump too, even with, all the market uncertainty floating around.
Okay, so let's unpack that record revenue number first. They pulled in $1.9 billion.
Yep, $1.9 billion. That's up 8% compared to the same time last year.
And interestingly, it wasn't just one side carrying the load. Both Moody's Investor Service, MIS, and Moody's Analytics, MA, grew by that same 8%.
Exactly. Balanced growth across the board.
And it wasn't just the top line, right? Their adjusted operating margin climbed too.
It did. Up 100 basis points, so a full percentage point, to 51.7%.
Yeah.
Really strong profitability.
Which naturally flowed down to the bottom line. Adjusted diluted EPS up 14%.
Yeah, $3.83. So like you said, strong performance, pretty much however you slice it.
Okay, so let's maybe zero in on Moody's Investor Service, MIS, for a minute. They actually hit their highest quarterly revenue ever.
They did, $1.1 billion, also up 8%, just like the total company figure. And that was driven mainly by a 9% jump in issuance volume, the amount of debt they actually rated.
Their margins there, even better than the overall company.
Oh yeah, significantly. Adjusted operating margin for MIS hit 66%. That's up 140 basis points from last year. Very impressive efficiency.
Now, you mentioned market uncertainty earlier, but they highlighted something specific driving growth in MIS, didn't they? Private credit.
Oh, absolutely. That was a huge theme, especially within structured finance. Get this, 143 private credit-related deals in Q1.
Wow, okay. How does that compare?
Well, in Q1 last year, it was 69, so more than double.
That's a massive jump. Where's that coming from?
So they broke it down. Roughly a third from private credit backing things like ABS, CLOs, RMBS. Another third from BDCs, business development companies, and fund finance.
Right.
And it's not just deal count. They said private credit directly drove 20% of their structured finance revenue growth.
Okay, so it's really becoming a significant factor, not just noise.
Definitely underscores how that whole non-traditional lending space is impacting the bigger debt markets.
And it sounds like people are leaning on their expertise more in general. The research and webcasts.
Yeah, engagement there was way up, like 2 to 3 times normal levels, they said. They chalked it up to market uncertainty.
Spins. People get nervous, they want analysis.
Exactly. They mentioned a recent webinar on tariffs pulled in something like 3,000 people from almost 90 countries.
Wow. So the demand for their core insights is strong.
Seems like it. And looking forward for MIS, the big long-term themes are still there. Private credit, obviously, transition finance for energy shifts.
Right, the green transition.
DII-driven infrastructure needs, and just growth in emerging and domestic debt markets generally. Those pillars seem intact.
You mentioned AI infrastructure. Was there anything specific on that? I feel like that's a hot topic.
There was. Data center debt, that really stuck out.
Wow.
In the asset-backed market, they saw $4 billion in data center debt issued in Q1 alone.
$4 billion in 3 months. How does that compare?
For all of last year, 2024, it was $8.4 billion.
Whoa. Okay, so the pace is really accelerating.
Massively. They even rated a huge $2 billion data center CMBS deal in the U.S. this quarter. It signals, much bigger financing deals happening for all this digital infrastructure.
So the plumbing of the internet needs serious capital.
Basically, yeah. And Moody's is right in the middle of rating it. They said they're looking closely at all the different ways these deals are being structured.
Fascinating. But despite this strong Q1, they did tweak their full-year outlook for MIS issuance, didn't they? Downwards.
They did. They're now expecting rated issuance for the full year to actually decrease by a low to high single-digit percent.
Okay. That's a shift from thinking it would be roughly flat before. Why the change?
Well, they mentioned April was a bit muted, and there's just generally more uncertainty about how the rest of the year plays out, policy, central banks, all that. So building in more caution.
Right. So that flows through to the MIS revenue outlook too.
Yep. Full year MIS revenue growth is now expected to be somewhere between flat and a mid-single-digit percent increase.
And the margin for MIS for the year?
They're guiding to between 61% and 62% adjusted operating margin. Still very high, but reflecting that revised top-line view.
One more thing on MIS, they brought in a lot of new clients.
Yeah, almost 200 first-time mandates. That's up 20% year on year. Pretty broad-based growth, too, except in Asia-Pacific.
And any particular type of new client?
Interestingly, yes.
Yeah.
A significant chunk, especially from financial institutions, were tied back to, guess what?
Private credit.
You got it. BDCs, asset managers, the private credit funds themselves. It all ties together.
Okay, let's switch gears then. Moody's Analytics, MA. How did that side of the business do?
Also strong. Their ARR, annual recurring revenue, key metric there, grew 9%.
Solid. Any particular drivers?
Decision Solutions led the pack with 12% ARR growth. And that recurring revenue number for all of MA is now 96% of their total. So very predictable, subscription heavy.
Okay, and within Decision Solutions, where was the strength?
Pretty widespread, actually. KYC Know Your Customer solutions up a really strong 17%.
Why such high growth there?
Demand from banks, obviously, but also corporates, vetting suppliers, and even governments in Europe looking into fraud, regulatory focus, efficiency needs.
Makes sense. What else in Decision Solutions?
Insurance grew 11%, driven by climate risk tools, specialty risk solutions, and they signed a new deal for cyber risk models with a big global insurer.
Cyber risk, yeah, that's definitely top of mind.
And banking saw 8% ARR growth, mainly clients automating lending workflows. New business specifically for lending solutions was up almost 20%. Their credit lens product grew 12% ARR over the year too.
Okay, so good momentum across Decision Solutions.
Cool.
What about the other MA parts, research and insights?
That grew ARR by 7%. Mostly their CreditView suite, the research assistant tool, analytics models, economic data. New business was strong there too, up 20% over 12 months. They expect low to high single-digit growth for the year.
And data and information?
That was up 6% ARR, but they called out a couple of things, dragging it down slightly, some adjustments to their ESG strategy, and some lost business with U.S. government contracts. If you strip those out, they said growth would have been more like 10%.
Ah, okay. So underlying trends still pretty healthy.
Yeah, and they expect high single-digit ARR growth for the rest of the year there. They're investing in data quality, linking data sets better, and focusing sales efforts, especially around their Max sites.
And across MA, they're still investing, but also trying to be more efficient.
Exactly. Investing in product development, tech platforms, sales capacity in those key growth areas, but also running a cost efficiency program to boost MA's operating leverage.
So what's the margin outlook for MA for the year?
Expected adjusted operating margin between 32% and 33%.
And they landed some big deals in Q1.
Yeah, a multi-million-dollar KYC deal with a major global bank. And they highlighted their first sale of what they called agentic AI in KYC.
Agentic AI? What's that? Sounds cutting edge.
Yeah, basically AI that can act more autonomously to get tasks done. In this case, it's for an AI screening agent they sold to a big crypto trading platform.
Interesting. So AI is a big theme for MA too.
Huge. They're really leaning into generative AI, using it for new products like automated credit memos, the KYC agent we just mentioned.
Right.
Also embedding AI navigators into lots of their products for customer support and using it internally too.
Oh, so internally.
Customer service, they said they cut resource needs by 20% using Gen AI, also using it in engineering, and even built a new AI tool for their sales team.
Okay, so AI is both a product and an efficiency driver for them.
Precisely.
Yeah.
Driving growth, improving the customer experience, and making their own operations leaner.
So summing up the MA outlook, they stuck with the overall revenue growth guidance.
Yep, reaffirmed full-year MA revenue growth at a high single-digit % increase.
But they did tweak the ARR outlook slightly.
There's trimmed the high end of the previous ARR growth guidance. Still expect high single digits, but acknowledging that, broader uncertainty might slow some customer decisions, plus that government contract attrition we mentioned.
See, got it. So let's pull back to the whole company picture. Moody's Corporation overall guidance for 2025. What's the headline?
They widened and slightly lowered the range. Full-year revenue growth for the whole company is now expected in mid-single-digit range.
And the overall margin?
Adjusted operating margin expected to expand between 100 and 200 basis points, so landing somewhere between 49% and 50% for the full year.
Okay, and earnings per share?
The adjusted diluted EPS guidance is now $13.25 to $14. That's still about 9% growth at the midpoint compared to last year.
Did they give any color on how the year might shape up quarter by quarter? Like the cadence?
Yeah, a little bit. They said for Q2, expect the overall revenue and especially the MIS margin to be maybe a bit below the usual seasonal pattern. Then revenue kind of stable between Q2 and Q3 before dipping sequentially in Q4. But MA, on the other hand, expects steady sequential revenue increases each quarter.
Interesting. So different dynamics between the two divisions through the year.
Seems that way. And operating expenses are expected to ramp up a bit from Q1 to Q2, then increase gradually through the back half. But the efficiency savings should help offset some of that.
And what about returning cash to shareholders? Share buybacks?
Still committed there. Maintaining the plan to repurchase at least $1.3 billion in stock this year. That's about 80% of their expected free cash flow.
Okay. Any other notable strategic moves or partnerships they mentioned?
A few things. A new partnership with MSCI caught my eye.
Oh, yeah. What's that about?
Providing independent risk assessments for private credit investments specifically. Trying to bring more transparency to that market, which, as we discussed, is booming. It's timely.
Definitely ties into the private credit theme. Anything else?
Integrating capabilities from numerated-enabled AI into their Credit Lens product for lending. And they completed the acquisition of Cape Analytics.
Cape Analytics.
Yeah, what do they do?
Geospatial AI data. Like using AI to analyze satellite imagery for property underwriting, they're plugging that into their catastrophe models for better property risk assessment.
Interesting tech integrations. So overall, it sounds like they're navigating a tricky environment pretty well, capitalizing on growth spots like private credit and AI, and keeping an eye on costs.
Yeah, that's a fair summary. Strong quarter, some caution built into the outlook, but the strategic direction seems clear.
All right, let's shift gears one last time. Time for our This Is Not Financial Advice segment. We look at the call, get maybe a little creative, outrageous but plausible trade ideas.
Always fun. What have you got sparked by Moody's today?
Okay, idea one, building directly off that data center boom we talked about. How about this? Long data center REITs, short high-yield corporate bonds.
Okay, interesting pairing. Unpack the logic. Well, Moody's themselves highlighted massive growth in data center financing. If that demand for digital infrastructure keeps rolling, the companies that own and operate those centers, the REITs should benefit, right? More leases, more development.
Makes sense. That's the long side. What about the short?
The short high-yield bonds ties into Moody's other point, their expectation that high-yield spreads might widen, defaults could tick up, general economic uncertainty.
Right. They did flag that caution.
So you're betting on a specific booming infrastructure niche while simultaneously betting against or hedging against broader corporate credit risk worsening. A bit of a specific growth versus general risk play.
I see it. Leveraging two different signals from the same earnings call? Plausible. Definitely plausible. Maybe outrageous, depending on your risk tolerance.
Exactly.
Okay.
Okay, idea two. This one focuses more on the Moody's analytics side, specifically that KYC growth. How about long Moody's analytics KYC-focused competitors, short traditional credit rating agencies?
Okay. Betting on the shift within financial risk management.
Yeah, Moody's emphasized how strong KYC and compliance solutions are, driven by regulation and efficiency needs. If that tech-driven compliance segment continues to outperform, maybe even because the issuance market for traditional ratings gets volatile,
then the companies really focus purely on those KYC compliance tech solutions might attract more investor interest.
potentially. While the pure-play traditional rating agencies may be facing those issuance headwinds Moody's guided towards, could lag. It's a bet on the evolution of risk tech versus the old guard.
Another interesting angle. Playing the divergence between different parts of the broader financial information and risk space, again, directly inspired by Moody's own commentary.
Exactly. Food for thought anyways.
Definitely.
So that wraps up our deep dive into Moody's first quarter 2025 earnings call. We hit the key numbers, the strategies, the outlook.
And even cooked up a couple of hypothetical trades.
We hope this breakdown gave you some valuable insights. But remember, none of this is financial advice. Always, always do your own homework. What stood out most to you from the call? Any questions still bouncing around? We'd genuinely love to hear your perspective.
Yeah, let us know.
Join us next time on Talk Tickers, where we'll tackle another important earnings report.